What extraordinary measures did Draghi's ECB take to save the euro? Imagine a time when the euro was teetering on the edge of collapse and the future of Europe's single currency was in doubt. That was the Eurozone crisis, a period of intense financial stress that threatened to break apart the currency union. During this turbulent time, Mario Draghi, the president of the European Central Bank, stepped in with actions that changed everything. His goal was to stabilize the euro and keep the European Union united. One of his most famous moves was in July 2012, when he declared that the ECB was ready to do whatever it takes to save the euro. This statement was a game-changer because it reassured markets that the central bank was committed to defending the currency. It helped calm fears and prevented a full-blown panic. Following that, the ECB introduced the Outright Monetary Transactions Program. This allowed the bank to buy unlimited amounts of government bonds from troubled countries like Spain and Italy. The catch was that these countries had to agree to follow certain fiscal reforms. This program aimed to lower the high borrowing costs that made it hard for these countries to pay their debts. It was a bold step because it involved the ECB directly purchasing sovereign debt, which was previously considered off-limits. The ECB also provided banks with large amounts of liquidity through long-term refinancing operations. These loans were at very low fixed interest rates and lasted for 3 years. The idea was to help banks cover maturing debts and encourage them to lend more to businesses and families. This was crucial because banks were hoarding cash instead of lending, which slowed down economic growth. Another extraordinary move was lowering interest rates below zero. This negative interest rate charged banks for holding excess reserves at the ECB. The goal was to push banks to lend more actively, stimulating economic activity and preventing deflation. The ECB also launched quantitative easing, a large-scale program of buying government and private sector bonds. This injected liquidity into the financial system, lowered long-term interest rates, and helped boost economic growth. While not a direct monetary policy, Draghi also supported reforms to strengthen the banking system. He backed the creation of the Single Supervisory Mechanism, which gave the ECB authority to oversee major banks in the euro area. This helped prevent bank failures from spreading and created a more stable financial environment. These measures were unprecedented for the ECB. They went beyond traditional policies, involved large-scale interventions, and challenged previous rules about how central banks could act. Draghi's actions helped restore confidence, lower borrowing costs, and stabilize the euro during one of its most difficult periods. His leadership showed that in times of crisis, bold and creative steps can make a real difference in saving a currency and a continent's economic future.